they have just cut interest rates for the first time since last year, lowering the Fed funds rate to a range of 4 to 4.25%. This move is aimed at supporting a slowing labor market. That's what he said, but it raises a huge question. What does it mean for inflation and for you? Because even though the employment numbers is showing weakness, the target for the CPI is at 2.9% higher this year. So it would appear that inflation is not under control, or at least farther away from their 2% target. What are we to make up of this information? Do we feel that there's a concern that inflation might not be under control? They want 2%. They may not get 2% for quite some time, but yet they have lowered the rates. And one thing you cannot do, you cannot lower rates in an inflationary environment. Are we in such an environment? That's a question. But more importantly for you, I want to find out whether or not mortgage rates are going to go down. So let's break it down, right? How this cut could impact mortgage rates. Are we going to see lower mortgage rates? And whether home buyers might finally get some relief. Number two, the big debate. Will cheaper credit reignite inflation? Or is the Fed making this move because inflation is already under control? Maybe 2% is too low. Maybe we should expect and be able to live with 3%. Why do we need such a low rate? These are the questions that we're asking. And finally, the broader picture. Are we heading into a soft landing? Or is this the start of something more like the early 80s stagflation period? Stay tuned. Let's unpack the data. Let's compare it to history and talk about what comes next for the economy and your wallet. Because these are very, very important issues. These are important issues that you need to understand. These are issues that, frankly, you need to understand. And I want my subscribers to understand. Okay? I want you to understand exactly what's going on. I want you to be familiar and fully abreast of, what does this mean at the end of the day. So, first of all, what is a relationship, right? What is a relationship between rates and this Fed fund rate? Well, you should know that mortgages, the 30-year mortgage is really tied to the 10-year yield. That's because most mortgages, most people stay in their houses for like 10 years. So what you're going to want to look for is what moves the 10-year yield. Now, as I'm talking, you're going to see some yield figures above or next to me. And basically, you would see that mortgages were high as 17% in 1981. That's because they raised the rate, and of course we had a recession. They raised the rate to cut the inflation. There was too much inflation at that time. And you could see the 30-year dropping and dropping and dropping to its lowest rate, around 2.79% in 2021. Then to shoot back up to 7, 8%, and to go back where it is today. So it's been a bit of a downward, really straightforward until 2020. And then, of course, we had COVID. Now, as far as the Fed fund rate, you will kind of notice that it also kind of went down and went up. but it's not such a straightforward relationship. Okay, just because the Fed is lowering the rates does not mean that mortgages are going to go down, because mortgages are not tied to the Fed fund rates, which just went down a bit, but they are tied to the 10-year yield. Why does the 10-year yield work? Well, the 10-year yield is essentially the interest rate the US government must pay to borrow money for 10 years. It reflects two main things. It reflects the expected inflation. Here's our key word here. And I want you to remember that, because inflation is going to play a key word, a key role in the actual mortgage rates. And the real yield, which is a risk premium, basically compensation for time up your money for long term. At the end of the day, this thing is driven by investors that either want to hold the 10-year yield or not to hold the 10-year yield. I know this might be a bit complicated for some of you, but you need to understand this, and I want my subscribers and my members to understand what's going on to make informed decision. I mean, should you buy a house now or should you wait? So when yields rise, investors expect higher inflation. You see? They demand a higher yield to compensate. So that means that if we feel that inflation is going to come back, then the investor is going to say, hold on a second, I know you've been lowering the Fed fund rate, but I'm not looking at that for mortgages. I'm looking at a 10-year yield. So if I expect inflation, and this is the key thing that you need to realize, is that inflation is what's going to be driving the mortgage rates. Right? So investors expect higher inflation, fiscal concern, right? That's going to rise the yield when massive deficit and debt issuance, can you say 37 trillion, some investors demand more yield to absorb the supply of bonds. Global shift, if foreign buyers reduce Treasury purchases, which is exactly what has been happening with China. China has been lowering the amount of Treasury securities that it's been holding. In fact, for the first time, the UK, England, now holds more Treasury securities than China. Of course, kind of not surprising that the president is over there for its second state visit. The UK is making a very big effort to be very, very friendly to the US, and to the point that they're holding lots and lots and lots of Treasury securities from the government. So if investors think, this is what you need to remember, if investors think inflation will stay high, they won't rush to buy the 10-year yield at current rates. They'll demand higher yields. And of course, and if this inflation is falling, demand for the 10-year increases, price will go up and the yield will fall. So the 10-year yield dropping is basically a signal that bond market trust inflation will come down. So that is what you need to watch for. You need to watch out what's happening with the 10-year yield to get a feel. And right now it's dropping quite a bit at around 4%. Therefore, that's why you're seeing mortgage rates going down. But you have to watch what happens next. Will we have inflation? Will inflation rear its ugly head? I mean, right now it's at 2.9%. Not a humongous amount of inflation. And it's not on the way down, though. It's on the way up. And the relationship between mortgage rate and the Fed fund rates hasn't been 100% correlated. It's been kind of following, but not exactly. But now, obviously, we're living in a very different environment. And the environment that we're living in is a bit complicated right now, especially since we await, what's going to happen with the tariffs, and also to the fact that the Fed, as we've seen yesterday, right? We heard the Fed talk yesterday, right? And you could see that they might not be as independent as they used to be. and their decision might not really be based on a concerted effort to fully understand what's happening, but rather to make sure that the will of the government is respected in terms of lowering the rates. And that's exactly what happened in the 70s and the 80s, where the Fed essentially abide by the will of the president at that time, which was Nixon, and lowered the rates even though inflation was on its way up. And you ended up with this yield that you could see, those charts that I'm displaying, those huge mortgage rates at 17%. You see, that is what you need to worry about, and that is what you need to understand. It's not complicated. All you need to figure out is, if people are talking about inflation a lot, then don't expect the mortgage rates to drop any further. And right now, it's still not that low. And frankly, with an economy that is doing well, I mean, look at what's happening with the GDP. Look what's happening with all the money being spent with AI. Yes, one thing you can say is, but hold on, what is happening with employment? Employment is very weak. In fact, it has been weak for quite some time, except that the data that we got from the BLS, the Bureau of Labor Statistics, was not accurate. And in fact, I will go as far as saying that the CPI numbers that you are seeing right now are not that accurate. And the reason I could tell you is because 30% of the CPI data is estimated. They're not getting the actual numbers. So you got to be careful, because you assume and then you realize, oops, you were wrong. Like at the beginning of the year, we looked at the May, June, July numbers. We were expecting 125,000 new jobs created, and they realized, it's not 100, 125, it's more like 40 and 60. And then to make matters worse, they realized, no, it's not even 60 or 40. In June, it's minus 12,000. We actually lost jobs in June. So obviously, you need to be worried about employment in the U.S. Now, can you have inflation at the same time where you have weak employment numbers? What's going on? It's a little confusing, but that's the situation that we're in right now. And the Fed is basically saying, okay, yes, I know we have lower rates. We have lower employment, which is not good, but we have higher inflation. But maybe the two will kind of balance each other. We shall see. Now, what could make inflation, and that's what you need to watch out for obvious reason. I'm sure you're seeing it already, but you need to figure out, if that's something that you're going to see. Why inflation could rise again? Well, lower borrowing cost, which that's what you're going to see. Consumer may take on more debt, fueling demand. People are going to go nuts with the lower rates and start buying your house. Housing rebound risk. If mortgage rates fall meaningfully, housing demand could return, driving up home prices. Because home prices have been going down through the various markets, energy and commodities. Any shocks in oil and gas or food markets could reignite price pressures. Any shocks in oil? Why would we have a shock in oil? Well, take a look what's happening with Israel, Gaza, Israel, Iran, Israel, and Syria, and in fact the recent attack in the Middle East. This is not a quiet period here. There was a huge fight a war between Iran and Israel, and they were concerned that at some point they would close the Strait of Hormuz, where most of oil tankers go through. Of course, the U.S. would not let that happen, and then I guess you would have to bomb someone to prevent it from closing. But the point is, all that nervousness and all that activity is pushing up oil prices, and oil prices are a major component of inflation. Energy is CPI, housing is CPI, and food is in a CPI. Those three items. Now the first one is obviously is the housing. Now why would inflation might stay contained? Well, the labor market is cooling, as we've seen. Job growth is slowing and wage pressure is easing, which typically reduces the demand-driven inflation. People are not working, they're not finding jobs, they're not going to be buying a bunch of things. Global supply improvement. Supply chains are smoother than in 2021, 2022, helping keep goods price steady. Meaning that you're getting the goods when you expect to get it. You're not stuck somewhere. Sticky disinflation trend. Inflation expectations are well anchored around 2 to 2.5%. So everybody expects some amount of inflation. And of course, the Fed credibility. Markets still trust the Fed will retighten if inflation spikes again. And that's the other question. Is the Fed credible? Did the Fed yesterday, when the Fed decided to lower those rates, why did they do it? Did Powell do it to get the president off his back? I mean, there's a lot of pressure on these people, right? They're looking. And they found something on Lisa Cook. She gets to stay for now, but she's got pressure. The building puts pressure on these people, right? The government wants lower rate and is pressuring the Fed from lowering the rates, Now, at the end of the day, you may say, well, why? I mean, the Fed is doing such a good job. Hold on a second. Do not think for 1 second that the Fed is this perfect institution. Yes, it needs to remain independent, but is it truly independent? As we've seen in the 70s and the 80s with Arthur Burns and Richard Nixon, the Fed was not independent. This year early, yes, I know that Powell said that, well, employment looks pretty strong, so I'm not going to lower the rates. Therefore, too late, Powell. And he didn't lower the rates. But then we found out later on that, well, hold on. We didn't have 150, 125, or 200,000 jobs created in May, June, July. It was only a mere 20, 40, or 50,000. In fact, we lost jobs. And so the data on which you rely to make a decision on rates was incorrect. And I guess you didn't assume any of it. You said, well, I'm looking at the data, and you don't think that maybe the data is wrong? No, because the data tells me what I want to hear, which is we have strong employment, so I will not lower the rates even though the president wants me to. But obviously, people at the Fed didn't think that either. They say, no, I know what the data says, but we feel that employment is weak. Look at it more carefully. Keep in mind that in 2021, when there was a lot of inflation after COVID reopened, after COVID reopened the country, huge amount of inflation, as you could see in the charts that are being displayed. The Fed did not do anything. The Fed did not raise rates under the Biden administration. And they would say, well, why not? Didn't you see there was a lot of inflation? I mean, don't you want to raise rates? And he said at that time, well, I thought it would be a transitionary period, and I make a mistake. You see, when you look at it this way, you could say, okay, but I guess you made another mistake earlier this year when the employment was that much lower, and you could have lower rates much earlier, and you didn't. But I guess it's not your fault, it's a BLS fault, and you believe them 100%. If I know that the BLS information is, like they say, it's mostly relying on survey and you're data dependent, are you that data dependent that you don't want to look beyond the data? Right? So at the end of the day, the Fed credibility, markets still trust the Fed will retighten if inflation spikes again. The market has to believe that. But now, because of everything that's happening within the Fed and the way they're reacting, and if you hear yesterday and take a look at some of the live feed that I put yesterday on the decision, you could see that it felt like someone And there was a couple of questions about the independence. Somebody that was losing the independence, I wanted to keep everyone, the ducks in one row, and wanted to just let's get it over with, because if I say if we don't lower the rates, we'll never hear the end of it. And yes, you could make a case to lower the rates because of employment, but also it's a little tough when you see the CPI at 2.9%. It's the highest level it has been in a while. So you don't have your inflation number under control. But I guess now you decided to look at the employment figure, which you did not look at before. It's hard for me to believe that these PhDs just look at the number and then assume maybe something is off with the numbers. A few of them did. And in fact, the new Fed governor appointed by Trump and of course nominated by the Senate the night before the news, he said, forget 25, we need 50 bips. We need to move faster. And the reason he's saying that is because by the time you lower the rate, right, it takes 12 months before you see the impact. So if employment is weakening and you want to stop it by raising rates, you're not going to see anything for at least 12 months. Because the way employment works, once it starts to weaken, it continues to weaken for a while. And that is the question. That now, why do we care about the 10 years so much? Well, the 30-year mortgage rate is a standard in the U.S., as we know. But lenders know most homeowners don't keep the loan for 30 years. Right? Historically, people sell or refinance after 7 to 10 years. So because of that, investors who buy mortgage-backed securities don't price them like a 30-year bond. They benchmark closer to the 10-year Treasury yield. That's the reason. So when the 10-year yield falls, the MBS yields falls too, and the mortgage rates follow, and vice versa. So if the 10-year yield is like 4.25%, add 1.75% spread, so make it 6%. So if the 10-year dropped by 3.75, then you're at 5.5. So yes, the reason mortgages act like a 10-year bond is because the average life of a mortgage is roughly 10 years. So you need to watch at the 10-year yield, which is around 4%, but you also need to watch for inflation expectation. That is very important. And going forward, we shall see what happens. But obviously the concern is that we might have a potential flare-up in inflation because, look at the latest numbers. Look at the latest numbers as far as the economy is concerned. It's pretty good, 3% GDP. Lots of money is coming into the country, to basically to invest in the country. Look at all the money the data centers are being built. The money that the presidency, by making those deals, let's see if they hold, if they're actually legal, but a lot of money is coming into the U.S. through all these deals that are being done in order for them to keep the tariffs very low. And that's what's happening right now. They're trying to keep the tariffs very low. So how Fed rate cuts affect the mortgages? Well, the Fed rate just cut the mortgage from by 0.25%. This directly impacts the short-term borrowing, like credit cards, HELOCs, auto loans. The mortgage rates, especially the popular 30 years, follow the 10-year yield. Bond yields often fall when the Fed cuts rates because markets expect slower growth or less inflation. So what you need to look forward whether or not you're going to have lower rates. And that That is a question that you need to look forward to. That's a question you're going to need to wonder. And the reason you need to worry about this is because obviously, we are mimicking very, very strongly what happened in the 70s. If you look at the inflation of the 70s and the inflation of now, they are moving in tandem. And technically, if we keep following at what happened in the 70s, we should see higher inflation. Now, of course, this could simply be a surprise. It doesn't have to be that way, but history repeats itself, unfortunately. And you have a Fed that is very lenient towards the president now, and you have a president or government that wants lower yield, lower rates, because obviously it makes everything cheaper, it moves everything faster, but you also have inflation that might not be under such control. Now, having said all that, it might actually be too late. Maybe the economy is already slowing down much faster than we thought. Although you gotta wonder, but why aren't we creating any new jobs? Since look what's happening, look what is happening to to the economy. The latest retail numbers are pretty strong. Retail sales are pretty strong. People are paying, even though things are more expensive. People are buying. People are feeling positive. So that's keeping up the economy, even though the numbers for employment are a bit weird, a bit weak. What gives? What's going on? That's a question you need to ask yourself. And it's a very important thing to ask yourself because the stock market is very strong as well. So technically, what are we saying? I mean, the stock market is doing well, reaching new highs. We just lower rates, so that's going to push the market even higher. And by the way, follow me and join become a member. It's only $5 a month, but it should help you really with some of my recommendation. Like I've been recommended, and now of course it's coming through the small caps. Right? You want to take a look at small caps. Why do you want to look at small caps? Well, because small caps are very helpful, and right now they've been underpriced for quite some times. No one has been looking at small caps because it was mostly Nvidia. Everybody wants to buy Nvidia, but that is not where the action is anymore. Why? As you're lowering rates, obviously, I'm not saying buy any small caps. Make sure. Again, join a member and you see a few of my recommendations. But you want to buy a small caps that is making money, that is growing, that has low debt, that has low valuation, that nobody really wants right now. That's what you want. And, you should get some gold small caps. You should get some rare mineral small caps. And the reason small caps do well because as the rates are going down, the short borrowing rate is also going to go down. It makes it easier for small company to borrow money to continue growing. That's the reason why small caps do well when you have a lower rates. But having said that, we have to realize also that be careful. Be careful because what we are seeing as well, real unemployment, negative GDP, and stagflation is causing minimal interest rate benefit. Well, we don't have a negative GDP yet. We don't have stagnation. The GDP numbers are quite good right now. The thing is, it's tough to see exactly what is going on because the numbers that we're getting from the Bureau of Labor Statistics are not the most accurate numbers. And some people have been complaining that, what's really going on, because it doesn't matter what you're seeing is happening, what you think is happening. because it's really happening in the background. And if your policy is off, if you're lowering the rates while if inflation is creeping up, which you have to wonder, but where's inflation is coming from? Well, it's coming from business activity. We're having very good activity right now. I mean, the AI expenditure is huge right now. We're supposed to get $600 billion from Europe, plus another 750 from Europe, plus another 550 from Japan. Every day we hear Apple spending another whatever, $500 billion in expenditures. And earlier this year, they signed the act to build huge data centers for $500 billion. I mean, is it everything going to happen this year? Not. But there's a lot of money coming in. Then, of course, you've got the money from the tariffs coming in as well, unless they're deemed illegals. But you're looking at potentially another $2 to $3 trillion of money coming to the Federal Reserve to the Treasury towards the national debt. So, I mean, everything is great except for one thing, maybe the canary in the coal mine, but employment is a bit weak. In fact, it has been weak for quite some time. And in fact, it has been weak even before the advent of the tariffs. Very recently, they said that there was 911,000 less jobs created between April 2024 to April 2025. That's before the tariffs. So something is going on, and it's probably the fact that rates were kept up too high for too long. Or not, okay? And the fact that the two issues that we're having right now is you don't have a good feel for the data, and then the Fed and the government is being very coercive in its approach towards the Fed. I'm sure they have good reason to be. After all, if they had the right data, they would have lowered the rates in May or in June or in July. Not now. So we're kind of late in a way, if you believe that those job numbers are no good. And frankly, this is not a new thing. They have been weak, and I'm sure you know people around you that are looking for jobs. The numbers have been weak for quite some time, and we did not know. And why we did not know? We did not know because the way they get those numbers, they get them from surveys, which I found hard to believe is that the Fed did not give credence at all, assume that the data was correct 100%. Now, of course, if you don't want to lower rates for whatever reason, I think it's Pete Navarro, I think, said that the reason is because Powell does not like Trump. I wonder why. Why he doesn't like Trump. But the point is that if you don't want to lower rates, you say, well, sorry, I don't know what's going to happen with those tariffs. And he said it a couple of times last year. And then you realize, you know what? Yeah, okay, fine. Let's lower rates because employment is actually lower than we thought. And you have no understanding of what's going on. Banks and government will benefit from lower rates, correct, not the consumer who is refinancing expiring bonds. Corporate are not replacing jobs using AI, and consumer will pay the tariff, which will lower reserve. Yeah, there's a lot of stuff in here. Banks and government will benefit from lower rates. Yes, because now it is cheaper for banks, because these banks that we're talking about, this Fed fund rate that we're talking about, is really the amount of money that banks lend to each other or lend to the Fed, right? So it is going to be cheaper for them, not the consumer. That is correct. The consumer, well, unless it's the short term, well, unless you have an ALOC, that's going to impact you. So that will impact your refinance, not your mortgage, no, but you have your ELOC, credit cards probably. Corporates are not replacing jobs using AI. That is true. That is what I've seen, that lots of the young people are being moved out of their entry level position, believe it or not, because AI can do the job. AI is basically this entity, really, that it's able to, it's like Google, I'm going to Google it, but it remembers what it just told you, and it is regenerating AI, meaning that it learned from what you're asking it to do. And you could go back and forth, like, give me this and show me that. And what do you think I'm told? Do you think I'm on the right track? And it's going to say, yes, you're on the right track. Things like that. So who needs someone to review the documentation and tell you what's in it? No, you just plug into AI and you tell it what's in it. You could tell AI, build me a course, on the geography. Build me a course on the history of the United States, and it will build you a course, literally. So maybe you don't even need a teacher. Okay. Co-op are not repricing, and consumers will pay the tariffs, which will lower reserves. That's true again. I mean, at the end of the day, the consumers are the one. Well, not so much right now, but the importer of the product is the one that's paying for the tariffs. Ford is paying tariffs from the 50%, tariff on India, or steel tariffs, right, from India or China, because they are the one that are paying the tariffs, not the people. Now, of course, they may decide to pass on the cost to you, but 50%, you're not going to buy the car. It's 50% more money. It doesn't matter who makes it. See, that is where it becomes very tricky. That is when you realize that this is a very, very precarious situation. And of course, to wrap this all up, the tariffs might not be legal after all, and we'll find that out by the end of the year. If it is deemed legal, I think it's going to be a great year. And the thing is, maybe or maybe not. The point is, do you want to FOMO, right? Fear of missing out. With the stock market getting higher and higher, do you really want to miss out? Right? Let me show you what's going on with the stocks. Look at that. It's all green. I don't think you want to miss out. I think that you want to make sure that I'll show you exactly what that looks like. But basically, you want to make sure that you stay on top of things. Look what's happening to the U.S. Right? It's all green. Green, 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 green. Continues to be green. Right? The market is doing fantastic. So let's keep it going. Now, having said that, you will notice one thing is you will notice that we're doing much better. We're doing better, but Japan is doing better, and some of the European countries are doing better. Walmart already raised their prices. And even when those tariffs go away, companies never lower prices. And that's the risk and the concern about sticky inflation. I mean, I agree because I shop at Costco, and I was there this weekend, and I saw that, the cost of the ribeye was at $22 a pound. Last time I checked, which was last week, I think it was 17 for the premium, and the choice was 13. Now it's 17. I'm not going to be buying ribeye at $22 a pound. Doesn't matter how much money I have. It's too much. So at some point, well, I didn't mind when the coffee was, the Nespresso cups went from $1.10 to $1.35. I say, okay, fine, 20 cents more. But now we're talking real money here. You want a piece of steak? It's $100. So it's starting to count. Now, of course, what's going to happen is how long will it take before the consumer says no? But right now, the consumer is still spending. So as long as that's going, everything is okay. Everything is fine. At some point, or maybe you don't get to that point. Maybe it's just fine the way it is. Maybe it's just, fear mongering. You got what you wanted. You got lower rates. You got a strong economy. You got a strong market. You're getting money from the tariffs. What's wrong with all that? Of course, it's being done in an environment that, a little bit rough sometimes. But listen, you don't make omelets without breaking eggs. But what I want for my subscribers and for my members, I want you to, look out for the black swan. And here, the black swan, my friends, is the fact that we may not, have, the inflation might not be over. Right? Inflation might still be a problem. And that's a problem because then you're back to the 70s. And if we take a look at the rates, and I think it's going to come up, I mean, we had mortgage rates. You had a recession in 1980, then you had another one in 1981 to 1982. You had two recessions back to back, where inflation just shot up. Mortgage rate from 8% all the way to, mortgages were 18% mortgage. Nobody's going to be buying a house at 18%, right? And that's what happened. They basically, the Fed fund rates, which is right now we're joking around at 4.25%. They had the rates as high as 19%. That's what it took. That is what it took to actually stop the machine. 19% rate. Fed fund rate, 19%. That means at 19%, nobody works. Everybody's fired. It's over. Recession. Cops at Walmart are hauling thieves off every day. Maybe somebody's hungry. And of course, when you have that kind of environment, then it becomes very hostile. And then you start to see behavior changing. When people have no jobs or people can't afford it, things come out, right? Things come out. And this is what you have to be very careful. We're living in a period of, important changes here. Now, of course, one has to wonder, but why did we do all this? Well, you're doing all this because, frankly, the U.S. is slowly losing its place as a premier, as a world superpower. Take a look, for example, what's happening between Russia and China and India. I mean, they're close to each other and they're talking, and at some point, some analysts are predicting that, at some point, they're going to do business with each other. They don't need the U.S. anymore. And they are becoming superpowers. Have you seen the display of power by China? And don't forget, right now there's lots of discussion going on between China and the U.S. as far as the negotiating the tariffs all over again with the trade, trade agreement between China and U.S. and they cannot agree. That is not a good sign. It's not a good sign that you can't get Russia not to fight with Ukraine. What is Russia thinking about? It's not a good sign that the U.S. is not dependent on its rare earth minerals. We're trying to catch up right now, with semiconductors. Recently, NVIDIA said they were going to buy, and don't forget, NVIDIA is actually paying the government for the ability to sell its ware to China, even though China canceled all the agreement with NVIDIA on its chips. It's very complicated, but the point, and the U.S. Took a stake in Intel, and NVIDIA is buying, stake in Intel as well, because Intel was, that's what started the semiconductor revolution. But since then, it has lost its place in the semiconductor race. It's losing that race. The U.S. is losing that race. It's going to lose that race within 5 to 6 years. So something needs to happen right away. So at the end of the day, we are living in a very interesting time, in very changing time, and very challenging time. Now, maybe it is just FOMO, right? Fear of missing out. Maybe everything works out. I mean, it depends. Look at the problem is you can't look at the data because you can't even trust the data. But we'll see. We'll see what it all ends. But what I want you to do, if you're thinking of mortgage and you want to know what's happening to mortgage rates, you need to look at you need to look at the 10-year yield, because that's what's going to drive the, and right now it's being very low, that's what's going to drive mortgage rates. And two, you have to see what's happening to inflation. If you think, suppose you see rates going down, down, down a lot, and you see that there's fear of inflation, then you better get your mortgage quickly, because inflation will drive mortgage back up. And right now, there's a lot of balls in the air, like if I might say so. I'm not going to go through all the situation, and that's why this channel is about. This channel is about understanding what is going on and looking at where's the next black swan? Where is it? Where's the next COVID situation is going to come from, right? Where is the next financial crisis? Is it going to come from geopolitical? Is it going to be a war somewhere? Is it going to be a huge amount of inflation? Is it going to be a China situation? Could it be a Russian situation? Who knows? But you need to be aware that at least it exists. You make money. You make money by protecting what you have, right? When you cross the street, your main goal is not to cross the street, right? When you're crossing the street, you want to make sure you don't get run over. That's your main goal at the end of the day. You don't say, I got to cross the street. I just close my eyes and just cross the street. So that's the same thing with your money. Do not look for the next Nvidia. Look for the next financial crisis. Look for the next bubble. That's what you do, and that's what I do every day in my membership. Every day I post videos only to my members, obviously, to explain to you what's happening, but more importantly, how to take advantage of it in the stock market. And right now, I would recommend highly, just in case we're totally wrong on this, to hedge your portfolio and buy some options for next year, just in case something happens, you lose your job or whatever. You have options available to make money in case something does not go well. And I will see you for our next live session.